Okay, so let's just start problem 8. Let's see where we can reach with problem 8. Neelam Brothers bought machinery on hire purchase basis from A Limited on 1st January 1993. The cash price of the machinery was rupees 40,000. So here right in the beginning they tell us the cash price of the machinery. Another thing, Neelam Brothers bought the machinery. So Neelam Brothers is the hire purchaser and A Limited becomes the hire vendor, and the agreement is signed on 1st January 1993. Cash price of the machinery was 40,000, payable in 3 equal annual installments commencing from 31st December 1993. Okay, that means there is no down payment here. There is no down payment here. Fine. So the cash price of the machinery was rupees 40,000, payable in 3 equal annual installments commencing from 31st December 1993. They have not told us the installment, they have just said there are 3 equal annual installments. The vendors charged interest on the outstanding cash price at 10% per annum. The annuity table shows that the present value of the annuity of rupee 1 for 3 years at 10% per annum is 2.48685. However, for the purpose of calculation, it was taken at rupees 2.50. So what they have run here is nothing big. They have just rounded up this figure. Instead of taking it as 2.48685, it's just taken as 2.5. It's the same thing. Okay, so that's what's done here. Neelam Brothers charge depreciation on machinery at 20% per annum on fixed installment system. You are required to calculate the annual installment and show the necessary accounts in the books of Neelam Brothers. Now what we have here, we have the opening balance, we have the cash price. Okay, 40,000. We know the cash price is 40,000. But what we don't know is how much is paid every year. They've just said payable in 3 equal annual installments. So we don't know. So if we don't know either the cash price paid or the installment, how can we calculate any of these things? Okay, so that's why using this annuity tables we need to calculate the installment. So here they've clearly said calculate the annual installment and show the necessary accounts in the books of Neelam Brothers. Okay, so let's do that. So here formula, annual installment is equal to cash price divided by annuity value. Annuity value. Cash price divided by annuity value. I can put cash price slash annuity value. Okay, so how I'm going to get the annual installment? So it's going to be equal to, what is the cash price? Cash price they've said is 40,000. So 40,000 divide by how much is the annuity value? They've said to take it as 2.50. 2.50. And this is going to give me 40,000 divided by 2.50 is going to give me 16,000. So each installment is 16,000. Okay, each installment is 16,000. Okay, now let's put that in that how I said, let's look at the logic of it. What are they saying is, the annuity table shows, now here what is the only difference is there they have given specifically for 3 years. Here they have combined it and given. If you calculate, if you actually see the annuity tables and take individually for 3 years at 10% interest, you will get the individual figures, and if you put those individual figures, you get this. So instead of giving it separately, they've given it combined. Okay, and anyway I showed you in the previous problem how to take it combined. How did we get that 2.73 is putting all the 3 years together. Here they have directly given it to you. That's why I did that problem first. Okay, that's why I did that problem first. So here they have directly given it to you. So let's see the logic. What are they saying? The annuity table shows that the present value of the annuity of rupee 1 is 2.5. So present value is 2.5. 1 is the future value. 1 is the future value. We already know the present value. Cash price is the present value. That is if we pay today in the present. Okay. Cash price is the present value. What is the future value? How are we going to solve this? 40,000 into 1 divided by 2.50. So this is how I get this. I've just not made up this formula. Okay, if you break down this present value of rupee 1 is the future value, is 2.50. We already know the present value now in this problem. Cash price is the present value. That is, if you pay today, you will be paying 40,000. Okay, if you pay in installments, you'll be paying much more. So 40,000 into 1 divided by 2.5 gives me 16,000. Is that clear? So this again is the logic part of it. If you don't want to know it, it's okay. You learn the formula. Is that clear? Is that clear, everyone? Okay. Now let's go to the statement. Now statement will be, so we know the installment now. Again, the installment it's going to be this part. 3 equal annual installment. They didn't say in 3 equal annual installments plus interest. They didn't say that. That means the installment is already inclusive of the interest. Same thing like the last problem. So which date this is happening now? 1st January. Okay. One thing. Is there down payment in this problem? Is there any down payment in this problem? Is there any down payment in this problem? Read the problem. Have they said down payment anywhere? Is there any down payment in this problem? I don't see any down payment, and there is no down payment. Okay. Now, whenever there's down payment, we start right at the beginning of the year. If you remember yesterday's problem, we started at the end. Why? Because there was no down payment. So when there's no down payment, we directly move to the date of the installment. Okay. 1st January or the beginning of the year is when there's down payment, but right now there is no down payment. So we are directly going to start with 31st December because that's the first thing. Is that clear? So I'm not going to start with 1st January. I'm directly going to start with 31st December because 1st January I've got nothing to show. There is no down payment. They are only talking about installments. So 31st December 1993. Opening balance of cash price is 40,000. The installment we have already calculated. Our installment is 16,000. So we are going to get our interest 40,000 into what's the rate of interest? Rate of interest. The vendors charge interest on the outstanding cash price at 10% per annum, and we are paying yearly installments. So it's going to be 4,000. So here we have 16,000 minus 4,000, which is going to be 12,000. Closing balance will be opening minus this paid will be 28,000. Do we have depreciation? I think we have depreciation. For the purpose of calculation, Neelam Brothers charge depreciation on machinery at 20% per annum on fixed installment system. Since we are at the end of the year, depreciation for the full year, how are we going to get our depreciation? Again, you can calculate it here or you don't have to calculate it here. And since it's a fixed installment method, depreciation is going to be the same every year. So 40,000 into rate of depreciation is 20%. So it's going to be 40,000 into 20% is 8,000. Okay. Come down for the next one. They said 3 equal annual installments. So we have to do it for 3 years. 31st December 1994. Opening balance is 28,000. We know the installment already, 16,000. How will we calculate the interest? Right now the interest has to be calculated on 28,000. So here you will get 2,800. So 16,000 minus 2,800 will be 13,200. Okay. 13,000, 28,000 minus 13,200 will be 14,800. We don't have to calculate the depreciation again. Why? Because it's a fixed installment method. Every year the depreciation is the same amount unless the period is different. If it's for 6 months and all, then it may change. But every year the depreciation is the same amount because we are following the original cost method or the fixed installment method. If it was a written down, what we have done, 40,000 minus 8,000 on 32,000, it would have been 20% for this. That is if it was the WDV or the written down value method. So the last installment now, 14,800. We know the installment which is 16,000. Are we going to calculate interest here? Are we going to calculate interest here? I want this 0. I want this as 0. So we are going to write the same amount and the balancing figure is going to be the interest. That is 1,200. Yes, very good, Rishi. So it's going to be 1,200. How did I get this? 16,000 minus 14,800. Okay. Total it 12,000 plus 13,000 plus 200 plus 14,800 gives me 40,000. You can check it. This will give the total interest is 8,000 and basically our higher purchase price was 48,000. So basically if you had paid it outright, directly paid the whole amount, you would have paid 40,000. But now you're ending up paying 48,000 because I said you're paying taking it on higher purchase basis. So you have to pay that additional interest. Is that clear? We also missed out depreciation. It's going to be the same amount. Depreciation is going to be the same. If it was written down value method, I think by now you should know how to calculate it. Okay. So, any questions with regard to this? Any questions with regard to this? I won't. I will complete the PDF, but I'm not going to make a recording for the posting of the entries. I won't be making a recording for the posting of the entries, but I will share this recording with you because I've recorded this part. Okay, but I will complete this and send you. Some of you who are solving by yourselves can also do it.